afternoon, 7 minutes after 4 o'clock. You're tuned to Money Radio 1510. Name of the program, Financial Review. My name's Sinclair. No, the doctor is in. We are getting you up to date on the markets and everything going on all across the world. Today is Thursday, October 27th, 2011, the only day like it ever. Hope it's been a good one for you. Yeah, my thanks to John Weatherby. John Weatherby is my new hero. Drew over in the newsroom, dude, I like you. You're great. But John Weatherby, you're my man. Staff meteorologist for Money Radio 1510. He's delivering. He's getting it done. It's a beautiful day. Here's what's coming up on the review today. We start, of course, in the first half of this hour by taking a look at everything that's going on all over the place. My views, my thoughts, my opinions, my interpretation of the news. In the second half hour, during our focus segment, our focus interview, we will focus in on trends with a guy who is just superb at this, Gerald Celente. I first met Gerald years back and started following his Trends Journal, and he comes up with some really intriguing stuff. Gerald Celente, Trends Journal, and we'll be talking about some of the major trends that are taking place right now and in the future, and that's always a lot of fun. Tomorrow, by the way, Open Phone Friday, that's tomorrow. Now, basically what we do on Open Phone Friday is we turn over the radio station to you. And you set the agenda. You get a chance to show your intelligence to the world, or lack thereof, whatever the case may be. But it's you. You take over, kids. Now, some of you have said, I don't really want to get on the radio. I got something to say, but I don't really want to get on the radio. There's a way for you to participate as well, and that is very simply write what it is you want to relay in an email. Send it to me, Sinclair at moneyradio.com. Sinclair at moneyradio.com. And I appreciate your emails. I do. Let's get down to business. Taking a look at Wall Street, Dow Jones Industrial Average up 339 at 12,208. S&P 500 up 42 at 1,284. NASDAQ Composite up 87 at 2,738. The yield on the 10-year note moving higher by 0.19 to 2.39%. Oil down 21 cents at 93.75. Actually, I think that's after hours, because that would be up fairly nicely from yesterday. And the precious metals moved higher. We'll deal with those in just a bit. Over the past few weeks, I've been reading newsletters and blogs that seem to have a recurring theme, and they had these fairly similar screaming headlines on the stories. Euro collapse, Euro crisis, Euro Armageddon, the global meltdown. I didn't read so much saying the Euro leaders would play a game of extend and pretend, and we'll probably see an imperfect deal, and there will probably be a rally on Wall Street, but that was my conclusion. That's what I've been telling you. You're welcome. The S&P 500 up 3.4% today. Its October gain is 14%. That's the biggest monthly gain for the S&P 500 since 1974. That erases the losses for the year. There has been a 20% monthly gain for the Dow Jones Transportation Average, which is sometimes considered a proxy or canary in the coal mine for the economy, if you will. That's the biggest monthly advance for the Dow Transports since 1939. The major indices in France, Italy, Germany, all up more than 5%. German and emerging market stocks extended their gains from this year's low, extended their gains to more than 20%. The euro up the most in more than a year. And then, of course, we saw the U.S. 10-year Treasury notes moving up very substantially as well to 2.39%. Maybe I've been a little bit too kind in calling this European deal an imperfect deal. Actually, it's a lousy deal, and there will be some problems down the road, but for now, there's a deal. The Euro leaders worked into the wee small hours of the night to hammer out a grand plan, and shortly after midnight they called in the bankers and they laid down the law. And then at 4 a.m. they announced the grand plan. Yeah, I can't wait to watch the miniseries. Here are the basics. Bondholders will be forced into accepting 50% write-downs on Greek debt. The EFSF, the big rescue fund, will be pumped up to $1.4 trillion, and Sarkozy made a point of expressing the amount in dollars, just to be sure we know it's still safe to spend dollars in Europe. The European banks will be recapitalized. The International Monetary Fund, the IMF, will take a bigger role. Italy will commit to reduce its debt, and the European Central Bank will make bond purchases in the secondary markets. Okay, let me simplify that a little bit. Banks must show losses, but then the ECB will pass out free money created out of thin air, and the IMF will try to privatize big chunks of the economy, and the peons and serfs in Europe will have to tighten their belts. Okay, that's not the exact language that they used in the official statement, but I can break down the official statement too. Here are some of the key points from last night's official statement on the grand plan. The statement said, all member states of the euro area are fully determined to continue their policy of fiscal consolidation and structural reforms. Translation: more austerity measures, more belt-tightening. The statement also said, we commend Italy's commitment to achieve a balanced budget by 2012 and a structural surplus by 2014, bring about a reduction in gross government debt to 113% of GDP in 2014, as well as the foreseen introduction of a balanced budget rule in the Constitution by mid-2012. Translation: we tried austerity in Greece. It didn't work. Now we're going to do the same thing in Italy. It won't work, but we won't have to deal with it for at least 9 more months. Statement also said, we invite Greece, private investors, and all parties concerned to develop a voluntary bond exchange with a nominal discount on notional Greek debt held by private investors. Translation: Greece is in default, busted, broke. They are toast. It'll cost 50%, and if you don't take it, if you trigger the credit default swaps, it'll cost you 100%. Take it or leave it. Statement went on to say, if necessary, national government shall provide support, and if this support is not available, recapitalization should be funded via a loan from the EFSF in the case of Eurozone countries. Translation: free money for banks. Woohoo! Too big to fail lives on in Europe. Woohoo! Statement went on to say, we will make further progress in integrating economic and fiscal policies by reinforcing coordination, surveillance, and discipline. Translation: you have all been very, very naughty, and we will punish you. We will not allow you out of the European Union. This is verboten. And then after the announcement that a grand plan had been reached, ECB President Jean-Claude Trichet said the measures agreed to have to be fully implemented as rapidly and effectively as possible. Translation, we bought some time. The whole thing could fall apart if anybody sneezes. Don't sneeze. Actually, this whole crisis will now be much bigger, and if it fails, or when it fails, it'll be a bigger catastrophe. This does not solve the fundamental problem of a 30% gap in the competitiveness between North and South. It does not address the intra-monetary union German trade surplus compared with the deficits of the Mediterranean states. It talks about austerity, but it does not realistically address the inevitable defaults of Italy, Spain, and Portugal. It does not address the whole deflationary downward spiral or the recessionary impact of all of these cuts. But, hey, it's a grand plan, except for the details. So, my advice to you, be very cautious with this rally. This is not the rally where you bet the farm. Interesting little side note, though, was the voluntary 50% haircuts on Greek debt, which stops the trigger of the credit default swaps. European Union's ability to write down 50% of banks' Greek bond holdings and still not trigger the $3.7 billion in debt insurance contracts. Why didn't this happen 3 years ago with AIG? Remember 3 years ago, AIG said, we got to pay out. Most peculiar behavior for an insurance company. You've got a claim? Sure, we'll pay. No problem. Insurance companies always question a claim. Meanwhile, back in the USSA, economic growth picked up in the third quarter. Total output, or GDP, grew at an estimated annual rate of 2.5% from July to September. Still modest, but almost double the 1.3% rate in the second quarter. The American economy has finally reached the size it was before the economic downturn began 4 years ago. It's taken 15 quarters for the economy to merely recover the ground lost in the downturn, significantly longer than any other recovery period since World War II. It's not enough to lower unemployment. There are still plenty of problems. What we've really lost here is the trillions in output between potential GDP, how the economy would have done absent the recession, and actual GDP. That's the actual cost in the downturn, the output, the jobs, the incomes, the opportunities, even the careers that were lost and may not come back. But the GDP was up 2.5% in the third quarter, and I guess that beats a poke in the eye with a sharp stick. Meanwhile, more than half of the companies in the S&P 500 have released their quarterly results. 3 quarters beat analyst estimates. Net income has grown 16% for the group on an 11% increase in sales.